What's up investors, Snooze here. Yesterday was a great day for the stock market, and in this video I want to talk about why it was a great day and a lesson in the attempt to time the market. A great lesson, so it's worth staying for. First, let's take a quick look at what happens in the market. So you can see here the S&P 500 rose by more than 2% after a few days of massive drawdowns, and most effectively, it happened in tech stocks, as you can see in the Nasdaq, that rose almost 4% in one day. And you can see it more clearly in the tech giants, for example. You can see Amazon rising more than almost 6%, Apple rising 3%. And if we take a look at smaller tech companies and more high growth tech companies like Snowflake, for example, so you can see it rose by 12%. And the subject of my other part of this video will be Shopify, that also rose almost 14% in one day. But we will get to that, and we'll get to that in the lesson about trying to time the market. Now, why do we see such high rises in stock, and especially in high growth stocks like Snowflake that are mostly defined by being high growth companies that are not yet profitable or not that profitable? So what in the market happened that allowed for this kind of companies to rise up so much? If we go here to the Barron's main page, the answer is right here. The 10-year treasury yield may have peaked. It makes stocks look better. So what does it mean? The 10-year treasury yield for the bonds has been on the rise for quite some time. You can see it here. This is the 10-year treasury yield. Now, if we look at 3 months when the drawdown in stocks began, you can see the steady rise. If we take a bigger look, you can see that, let's say, in 5 years, so you can see that since 2020, where the yield gone really low, this is the very high rise of stocks that we all saw on 2020 up until 2021. And then we have a rise here, a bit of a fear, but then it stabilized. So we saw another good run for stocks. But this is what happened since 2022 began, the rise of the high yields. And this spooks a lot of investors. So we will get to that. We'll talk about the yield curve and what it means for the stocks, but let's take a quick look at the 3 months just to have a sense of what Barron's mean when they say that the 10-year treasury yield may have peaked. So if we look here, we can see that a steady rise for the last 2 months, and then here it started to stabilize. It started to go down a bit and then up a bit, and then just yesterday down again. So let's go to context of 5 days. You can see that it went down, and then yesterday it just stabilized, and investors think that it might have peaked and stabilized. So that gives a better perspective for stocks, and specifically for stocks that are not yet profitable and that are high growth, like Snowflake and all these kind of stocks. Let's take a quick look at the yield curve. A short introduction for yield curve if you have missed all the news that talked about it. The yield curve is the difference between the bond yield for the US Treasury for long term versus the short term. If the short term offers higher yield than the long term, that means that the yield curve has inverted, because it's not natural for the short term bond for 2 years to give you more yields, more returns than the long term. That happens because investors expect the short-term bond yields to rise faster than the long term, and that means bad things for the stock market. And it's been a great indicator for recessions in the past 100 years. So here we see the yield curve on the last 30 or 50 years. Let's go to 30 years. Here is the 10 years to 1 year yield. Usually when people talk about the yield curve, they talk about the 10 year to 2 year. That's why you see a bit of difference, but let's focus on the 10 to 2 years. You can see that prior to 2008, it crashed. Prior to the dot-com bubble crash, it also inverted. And right now, you can't see it, but it also happened a month ago you can't see it because it just touched it and gone up again. So if we minimize the view here, let's focus here. You can see it. It just touched the inverted point and then went up again. And now that the 10-year treasury bond is stabilizing, it means that we may not go back to the inversion, and that settles down a lot of investors. And that means a great thing for many stocks, especially for high growth stocks. Now, the point for me is not to look at this kind of graphs and try to predict the market, because that's a fool's errand. I don't know what will happen tomorrow. Nobody knows, and that's the point. Nobody knew that the 10-year treasury yield will flatline yesterday and then send the stock soaring. You can't predict that. And if you try to predict that, you play a game you can't win. And the point here is that don't try to time the market. If you see a stock that you value and you do all your work, you read the reports, you understand the business, you do the valuation, and you think the valuation is good, then it's a good point to buy, because you can't predict this macro environment in the short term. You never can. And so the stock may go down a lot more, or it may go up 14%, as we saw here. Let's go back to Shopify. It can go almost 14% in a day, and you might miss a good run. My experience with that is that I tweeted a few days ago, actually in May 6th, I took a first position in Shopify. You can see here the price. Let's get it larger. I bought it for $397. That's the first position that I took. Now, it looks good now because Shopify is above 400, but for almost 10 days since this purchase that I made, it looked like a very bad decision. Let's look at here at Shopify, and I bought around here for $400. And then for the next few days, it went down. Now, in this context, when we look here, it doesn't look so bad, because in the next few days, the drawdown continued in a rapid pace, where it even got down to $318. And from $400, which I paid, it's almost 20% drawdown. That's a really bad return, but it was a temporary thing because it had the yesterday rise, which brought it back to the same place, even a bit higher. So if I tried to time it and I say maybe I will wait and I won't buy until the drawdown will stop, I would have missed a great day. Now, for me, that's not a great case, because the great day merely got the price to the same place. But a lot of examples like that showing you that you may have missed the great day, the great rise back to a reasonable price. Now, it's not worth really looking into that hard, because we're talking about days. When we buy stocks, we buy it for years, we buy for the compounding. The lesson here is don't try to look at the macro environment on the 10-year yield or the inverted curve yield or things like that. Look at the business, analyze it, and if it looks good and if the value is good, it's good buy. And for the Shopify case, I'm working on an analysis and a write-up on the stock and valuation, so watch for it. And that's it for today. I hope to see you next time. Bye bye.